Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial. If you like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen. And while at my website, click on our podcast page to check out our past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. All right. Many people think that investing is only something you do during your career when your goal is to pile up enough assets to help you retire and enjoy your preferred lifestyle. Many people, well, in truth, there's no reason you can't keep investing after you fully kicked back and embrace the retirement lifestyle. After all, the more you grow your finances, the better off you're likely to be, even in retirement. But before we get into our timely topic, let me introduce my co host, Tony Shore, who this show will always keep investing in because you know what? He's just so essential. Hey, Tony, how we doing, buddy?
Well, let's not get carried away, but yeah, I love being here, and flattery will get you everywhere.
Love it.
You
Love
know
it.
that. So, um, a full confession: I've always assumed we're supposed to stop worrying about investing once we're retired.
Okay.
But it sounds like I'm about to be proven wrong. It still is important. That's good. And I'm glad you're going to talk about this because a lot of people think, once they retire, there's not much they can do. But there are things, especially leading up, but even in retirement. So I'm anxious to talk about that. First, how have you been, Albert? I know you're keeping busy over there, aren't you?
Yes, yes, yes. Weather's warming up a little bit. We're getting some
Yep.
rain. Got to play my first round of golf over the
Oh,
weekend
wow.
for the season.
Already.
So, yes, yes. So a little chill, but I tell you, it wasn't bad. The sun was out on Saturday and probably in the mid 50s. So it was a nice start for the season. I'm ready. I'm ready for
Did you
golf.
watch the Masters
I
tournament?
did. What a finish that was.
Yeah.
Wow.
Yeah.
Unreal. I mean, I thought he was going to blow it, but
Oh, yeah. He
good for him.
tried. He tried a couple of times. Biggest comeback ever. I don't think anybody's ever,
Yeah.
he set a
Oh,
couple
yeah.
of records,
Yep.
for so that was crazy. So, well, great. And now this topic, should retirees keep investing? How do they do that? Where are we gonna start with this?
You know what? Let's start with an article from Forbes titled, Here's Why You Should Continue Investing After Retirement. First, retirees should view themselves as long term investors. Remember, retirement isn't a finish line, it's actually a brand new chapter. And even if you retire, let's say, right on schedule at, let's say, 65, your journey is far from over. In fact, you may have 30 years or more of life still ahead of you. And
Yeah.
recent study from JP Morgan noted in the article that found that a healthy non-smoking couple has a 46% chance that one of them will live to 95. And there's a nearly 1 in 5 chance they'll reach 100. And that's not just longevity, that's just an opportunity. So here's where things get tricky. When the paychecks stop and you start drawing from your savings each month, it's easy to slip into, let's say, a short term mindset. Understandably so. Monthly expenses don't take a vacation in retirement, though. Still, this can cause many retirees to see themselves as, let's say, short term investors, even though they're often only tapping a small slice of their portfolio each year, Tony.
Yeah. Yeah, well, and that's interesting. I know that, uh, people need to be aware of these things. That's why they work with you. So what's the move here? I mean,
Well,
what should you do?
first, most retirees really need to understand that long-term investing is still what they need to be doing.
Yeah.
There's real power in embracing that perspective.
Sure.
First, it gives your portfolio room to breathe, to weather downturns, bounce back over time. Just as important, and it helps you stay focused on the long game, making sure your investments continue to grow and keep pace with inflation so your money works as hard as you did. And then remember, retirement may mark the end of your career, but it's also the beginning of your legacy, and you should plan accordingly, Tony.
Yeah. Well, of course. And again, you don't have to do it alone. What better way to plan accordingly than work with Albert Lalonde, a financial services professional who's going to guide you, right?
Sure, sure. You definitely would like to get professional assistance. That would help tremendously. In fact, then the next thing the article really talks about is that your stocks may offer needed returns. And when you're investing for the long haul, time still becomes your greatest ally. And over the span of, let's say, 30 years, the market has rewarded patience in a big way. In fact,
Yeah.
since 1977, US stocks have delivered returns twice as high as ultra conservative T bills. Now, that's according to data from Portfolio Visualizer that they shared in that article. And when we zoom out to, let's say, 15-year rolling periods going all the way back to 1928, the story stays the same. In fact, stocks average 9.8% annually, while T bills lagged far behind at just 3.34%. And that's not just a difference in numbers, it's a difference in outcomes.
Hmm.
Now, let's be honest, stocks do come with more ups and downs. During the past 50 years, their volatility, which is measured by standard deviation, was about 5 times greater than the T bills. But here's the key: if you see yourself as a long term investor, you don't have to fear the waves. You just learn to ride them.
Yeah. As long as you've got a great captain in that boat, which is a financial services professional, you don't have to ride the big waves alone or any of the waves, right?
Right. I mean, think about it. A thoughtfully built, well diversified portfolio that you build in close partnership with a financial service professional can really smooth out much of that ride. Now, let's take a classic 60/40 blend of US stocks and T bills, for instance. That mix has shown a standard deviation about 40% lower than an all stock portfolio, meaning less turbulence without giving up all the journey's rewards. Now, the bottom line: volatility is part of the price of admission. But with a long term mindset and the right mix of investments, it's a price that could, well, be more than worth it paying down the road.
Yeah. Of course. Now, how does inflation factor into all of this?
Well, inflation doesn't knock on the door here, Tony. It quietly slips in and makes itself at
It's the
home.
silent killer. That's
It
what they
really
call
is.
inflation,
Yes.
the silent killer.
For sure. And for retirees, it's one of the sneakiest and the most dangerous
Yeah.
threats to long-term financial security. In fact, over 30 years, even modest inflation can dramatically reduce your purchasing power. Now, what seems like a small year-over-year increase in prices adds up, and they add up fast. And sometimes inflation doesn't move quietly at all. Let's look at 2022 when prices jumped sharply in just a matter of months. Or think back to retirees in the late 60s, 1960s, who faced the relentless inflation of the 70s and early 80s, which was a tough time stretch for fixed income.
Yeah. So, how do you invest your hard-earned savings then?
Great question. The goal is to have your money grow faster than prices rise, obviously. That means leaning into investments that is historically outpacing inflation. So T bills, while stable, often struggle to keep up like that. And then stocks, on the other hand, have shown strength over time, delivering long term growth that can help preserve your lifestyle, not just your capital. And remember, for your bond allocation, the article explains that tools like TIPS, treasury inflated protected securities, can be a smart addition. They're designed specifically to rise with inflation. So that way they help you maintain real purchasing power even when prices climb.
Yeah, and I know you've talked about other options on the show too, Albert, in
Mhm.
how to keep up with inflation, right?
Yes,
And that's the key. That's why we put money at risk in the stocks, is so our money will grow and outpace inflation. But there are other vehicles where you can get returns and more principal protected options where you can still outpace inflation, but make sure you have some of that downside protection. You just can't have all your eggs in one of those baskets, right?
correct,
Yeah.
correct, correct.
And so it gets complicated. Asset allocation in retirement to make sure your money's going to last as long as you do, or you don't make costly mistakes. How can our listeners get a hold of you if they want to ask questions or get that plan in place?
Yeah. Folks, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen, or call my office, 586-752-7008, and discuss how we can answer your questions and address your concerns about investing during retirement, your overall retirement, or any parts of your financial strategy.
All right. Well, that sounds great. And listeners, let's keep rocking and rolling. Albert, been a great discussion so far, talking about for many retirees, the smart play is to keep investing, keep some money invested in the stock market rather than just hunkering down with the assets you already have. Don't keep it under the mattress. You're not going to keep up with inflation. A great conversation so far. What's next?
Well, let's continue with that same article by Forbes. Here's why you should continue investing after retirement. It next addresses a very interesting question. How much should you invest in stocks before you retire versus after retirement? Now, your investment mix shouldn't stand still, that's for sure, because your life doesn't. And when you're just starting out onto your journey to retirement, time is on your side. That's why younger investors, those with decades ahead of them, can often afford to lean, let's say, heavily into stocks. In fact, a 90 to 10 split between stocks and fixed income isn't unusual, at least according to the article. In fact, some long term investors go all in on stocks during their early years of saving. Now, the article adds that even Warren Buffett, in his 2013 letter to Berkshire Hathaway shareholders, suggested a 90% stock and 10% bond allocation for long-term growth. Why? Because when you've got time, you've got room to ride out the ups and downs and capture the market's long-term gains. But as retirement draws near, and especially once it begins, well, it's time to shift those gears. Yes, retirees are still long term investors, but now there's a new dynamic in play: monthly withdrawals, income. You're not no longer just growing your wealth, you're living off it. And that's why many financial service professionals recommend gradually reducing stock exposure and adding more fixed income. In fact, this shift, often called a glide path, that helps smooth the transition from accumulation to preservation and income.
Yeah. Well, there you go. And that's good. You do have to know how to make that transition. That's where a lot of people get stuck or make costly mistakes. So here's a big question for you, Albert. How much should you keep in stocks during retirement?
That's great, great, great question. In fact, but the answer isn't a one size fit all, Tony, unfortunately. However, research have helped guide the way, and an article explained that back in 1994, Bill Benden, father of the 4% rule, found that portfolios holding 50% to 75% in stocks produced the most sustainable withdrawal rates over time. Well, why not go higher then? Because history has also shown us what can happen if you do that. A retiree, let's say, sitting in a portfolio that's 100% stock during, let's say, a 1929 style crash, could see their nest egg fall 90% in only 3 years. Now, on the flip side, going too conservative, let's say less than 50% in stocks, can leave your portfolio vulnerable to inflation, like we saw in the 1970s. So the article tells us that's why the 60/40 portfolio has become, let's say, a classic. It aims to walk the line between risk and versus reward. But let's be honest, the right allocation is the one that fits your goal, your lifestyle, and your financial peace of mind, because retirement isn't just about numbers. It's about confidence, freedom, and waking up each day knowing, you know what, you're right where you need to be.
All right. Is there ever a point at which a person should simply stop investing in stocks or get out of the stock market?
Well, listen, not every retiree needs to invest in stocks, but some may still want to. Let's say you're in a fortunate position. So, security and a pension covers your lifestyle comfortably, and you're not relying on your portfolio for monthly income. Well, in that case, you might reasonably choose a more conservative approach, investing primarily or even entirely in, let's say, fixed income. And for those in the later stages of life, preserving wealth may take priority over growing it. But here's where the article gives us slightly a little twist. Those who don't need to take risks may be the best position to embrace it. If you can weather the market's up and downs without needing to draw from your investment, you're in a powerful position to capture the long-term growth potential that stocks historically offer. In fact, over time, stocks have consistently outpaced bonds, sometimes by a wide margin. So this can open up an opportunity not just for you, but for those you care about the most. Think like enhanced planning. If you don't plan to spend your savings, but instead want to leave, let's say, a lasting legacy, a growth focused portfolio could serve your ears very well. And then in the long term performance potential, it could help you pass down significantly more wealth to the next generation. Because sometimes investing isn't just about you, it's about the future you're building for those you love.
Okay. And here's a question some of our listeners might have, Albert. How can working with a financial professional like yourself help retirees out there with their investments?
Well, let's remember retirement doesn't mean stepping away from the stock market. It just means approaching it with more intention. And a skilled financial service professional helps retirees invest with confidence by aligning their portfolio with their goals, lifestyles, and comfort with risk. Now, for many retirees, the market can feel a bit intimidating, but a good financial service professional brings clarity to them. We help you define what you're investing, whether it's for growth, legacy, or simply to keep pace with inflation. From there, we can craft a diversified portfolio that balances growth potential with downside protection. We can also guide your income strategy, and that might mean using, let's say, a bucket approach, building a dividend stream, or planning dynamic withdrawals. So you're not forced to sell stocks in a down market just to meet your needs. Now,
Hmm.
we stay steady with emotions run high, markets rise and fall, but panic is optional. So a financial services professional serves as, let's say, your soundboard, your strategist, and sometimes your emotional anchor, Tony, and helping you stay focused on your plan when headlines or market swings try to pull you off course. Now, ultimately, we're not just managing money, we're managing financial peace of mind. In fact, with a solid written financial plan, you can continue investing in stocks not out of fear, but with purpose, knowing your money is working for you, your lifestyle, and your legacy.
Yeah, there you go. Well, I think this has been a great discussion today, Albert. And I think the key here is don't give up on your plan, stay the course, and you have to have some growth in your plan throughout retirement. Just because, you hit 75 and you're in retirement or you hit 80, doesn't mean you don't need to have a plan and have investments. That's for sure. And it depends on the person's situation. I got that message loud and clear from you today, right? I mean,
Mhm.
you have people come to you, Albert, and it's different for everyone, isn't it? I mean,
It is, and you have to understand. I mean, even though I'm speaking in and to continue to invest, make sure again, as the article explains, that you have your income set up first and everything, and then it's that discretionary asset that you don't need for income that you want to go ahead and still be in stocks and make sure that you can take a little bit of risk because that asset has time for you.
yeah. Yeah, and it depends where you're at, how much you have saved for retirement, how much you need to live on for your goals and lifestyle, and how much you want to leave behind as a legacy. And, we've talked about these things on past shows, but it really does help answer the question. Yes, retirees should keep investing. That's the answer, and that's the message here today. Now, before we go, let's talk about how our listeners can get a hold of you because you offer a no charge, no obligation consultation. You leave the checkbook at home, you just ask questions, you get information and get a plan in place. You'll run some reports for them and then see where they want to go from there. I think that's really, really helpful. I know my wife and I have done this. So if our listeners want to get a hold of you to do that, how can they do that?
Yeah, folks, you can always visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen, or call my office at 586 752-7008. And come on for your complimentary financial plan. We'll see where you currently are now, where your mix is, and can you afford to have a little bit more risk or less risk. And remember, it is our goal to help you prepare for the retirement you worked hard for so that you can own your retirement.
All right. Well, thanks, Albert. And again, that number, listeners, is 586-752-7008 if you want to call and set up a no-charge, no-obligation consultation, or go to kaizenfinancialgroup.com. That's Kaizen financialgroup.com. Thanks, Albert. Thanks, listeners and viewers. That does it for today's episode of Own Your Retirement with our host, Albert Lalonde.
Take care, everybody.